Hello and welcome back to Money Never Sleeps. My name is Timur from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mandawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. During today's show, we'll discuss retirement income and how much you're likely to need, as well as how to invest and save for retirement if you have little money. A U.S. News and World Report article, What is a Good Monthly Income in Retirement, provides us with some very useful information. Step 1 is to define what a good retirement income is for you, and it might not be as tricky a task as you think. A financial services professional cited in the article notes that most clients already have a solid idea of how much they'll need in retirement. This is because their retirement budget often closely mirrors their expenses during their working years. After all, no one wants a lower standard of living in retirement. While some work-related costs, like commuting, lunches out, and work clothes, disappear, retirees still have housing and utility bills to cover. Additionally, new expenses may pop up, including travel, hobbies, and entertainment. Retirement spending also varies by stage. Newly retired individuals may spend more as they travel and pursue long-delayed dreams. By mid-retirement, expenses often decline as life settles into a steadier rhythm. Later in retirement, however, costs may increase again due to healthcare and potential long-term care needs. The article next highlights how much the average retiree spends. While every retiree's income needs will vary, looking at national averages can provide useful insight for planning. The Bureau of Labor Statistics tracks consumer spending through its consumer expenditure surveys. In 2023, the most recent data available, U.S. households led by someone 65 or older spent an average of a little more than $64,000 annually. However, most retiree households spend significantly less. According to the 2022 Spending in Retirement Survey by the Employee Benefit Research Institute, which surveyed nearly 2,000 American retirees aged 62 to 75, the vast majority reported spending less than $4,000 per month. Let's next consider where many people get their retirement income. Once you have an estimate of your retirement expenses, the next step is determining where that money will come from. A financial services professional can offer guidance, and one expert cited in the article emphasizes their goal of helping clients start each month with $5,000 in the bank. According to the article, retirees typically draw income from 5 primary sources: Social Security, investment portfolios, annuities, part-time employment, pensions. Additional income may come from rental properties or by accessing home equity through a reverse mortgage. While traditional pensions have become increasingly rare, Social Security remains a critical source of income for retirees. In fact, nearly 90% of Americans aged 65 and older receive Social Security benefits, according to the Social Security Administration. As of December 2024, the average monthly benefit for retired workers was $1,975, equating to an annual income of $23,700. While helpful, this amount may not be sufficient to sustain a household. Relying on part-time work to bridge the gap may seem like a viable option, but it's not always a long-term solution. Many retirees assume they can continue working indefinitely, but at some point, physical limitations may make that impossible. This is why saving for retirement during your working years is essential. Contributing to a 401k, IRA, or other retirement accounts can help supplement Social Security and provide financial stability, ensuring you have enough income even after you stop working. Finally, the article emphasizes the importance of turning savings into a steady cash flow. Withdrawing money as needed may seem straightforward, but retirees must carefully manage distributions to avoid depleting their savings too soon. A common guideline is the 4% rule, which suggests withdrawing 4% of savings annually. For example, a retiree with a $1 million nest egg could generate $40,000 per year, while someone with $500,000 in savings would have an annual income of $20,000. However, the article points out that this rule doesn't account for taxes, an important factor in retirement income planning. The way you withdraw funds will significantly impact your tax burden. Many retirees hold savings in traditional 401k plans and IRAs, where withdrawals are taxable. Additionally, at age 73, retirees must begin taking required minimum distributions, which can increase their tax liability. One strategy to reduce future taxes is to convert funds from traditional accounts to Roth IRAs before retirement. While Roth withdrawals are tax-free, the conversion itself is taxable, requiring careful planning to minimize the impact. Let's continue our conversation about retirement finances by looking at investing and saving. Another U.S. News and World Report article, How to Start Investing and Saving for Retirement. With Little Money really jumped out at me because it's packed with good info. Many Americans have long assumed that investing in stocks, bonds, and mutual funds requires a substantial bank account. While that may hold true for high-priced stocks at the top of the S&P 500, it doesn't mean investing is out of reach for those with limited funds. Take the Magnificent Seven: Apple, Alphabet, Amazon, Meta Platforms, Microsoft, Nvidia, and Tesla. These companies boast trillion-dollar market capitalization, making them seem unattainable for small investors. However, the article highlights that anyone can start investing regardless of their financial situation. There's no rule requiring a minimum investment of $1,000 to enter the market. For those with limited cash flow, here's some steps to begin investing and build long-term wealth. Start small and build momentum. Review of your finances. Take advantage of workplace retirement plans. Use micro-investing apps to buy fractional shares. Consider real estate investment trusts. Leverage dollar cost averaging. Prioritize saving by paying yourself first. Educate yourself about the stock market. By following these strategies, even investors with modest resources can begin growing their wealth and working toward financial security. That's the perfect segue to the article's next key point. When investing, start small and build momentum. If you're living paycheck to paycheck or struggling to save, don't stretch yourself too thin when starting your investment journey. Even if setting aside money seems difficult, consistency is key. Small contributions can grow significantly over time. While the general rule of thumb is to save 20% of your income, that may not be realistic for everyone. If 20% feels overwhelming, start with 10%, $20 a week, or whatever amount fits your budget. To begin, consider opening a high-yield savings account that offers 4 to 5% interest rather than a traditional savings account with less than 1% APY. And remember, investing comes with both rewards and risks. If it's part of your financial strategy, it's wise to consult a financial services professional to ensure you're making informed decisions that align with your goals. The article next emphasizes the importance of thoroughly reviewing your finances. Before setting investment goals, it's wise to start by assessing your current financial situation, ideally with the guidance of a financial services professional. Take a close look at how much of your income goes toward fixed expenses like rent, taxes, car payments, and student loans versus discretionary spending on food, entertainment, and shopping. Once you have a clear picture, outline a rough plan for how much you'd like to invest over the next year. Establish a household budget, prioritize essential expenses, and set up automatic contributions to your savings and investment accounts to stay on track. Next, focus on maximizing contributions to your company retirement accounts. Prioritizing tax-advantaged accounts is crucial because they offer significant benefits, though early withdrawals come with restrictions. Additionally, investing in taxable investment accounts can provide more flexibility for accessing funds when needed. If your employer offers a 401k match, take full advantage of it. Matching policies vary, but many companies match $1 for every $1 contributed up to 3% of your salary, then 50 cents on the dollar for the next 2%. This is essentially free money that can significantly boost your retirement savings. The article next recommends leveraging dollar cost averaging, a strategy that makes investing more accessible through small, consistent contributions. With dollar cost averaging, you invest a set amount at regular intervals, whether weekly, monthly, or even daily, regardless of market fluctuations. Many investment platforms now support this approach, allowing you to purchase fractional shares of stocks, mutual funds, or other assets with ease. The most challenging step is simply getting started, but once you do, those steady contributions can grow into substantial wealth over time. Next, collaborate with a financial services professional to build a solid understanding of the stock market. Educating yourself is just as important. Stay informed by reading financial news, listening to podcasts, and following market trends that could impact your investments. The stock market is a complex ecosystem, and having a clear strategy is essential. Once you've learned how to evaluate stocks and plan trades, consider practicing with a test trading account before committing real money. After refining your strategy through practice, confidently execute your actual trade plan, but only with the assistance of your financial services professional. And be mindful of common investing pitfalls, the biggest being emotional decision making. Avoid buying or selling stocks impulsively. For example, don't invest in an obscure cryptocurrency just because a friend saw quick gains, and don't panic sell a stock just because its price drops, especially if your overall strategy hasn't changed. Sticking to your plan is key to long-term success. Working with a financial services professional can help you stay disciplined, avoid costly mistakes, and navigate the market with more confidence. If you have any questions about your retirement magic number, your retirement strategy, or any other parts of your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure: all matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.